I'm going to talk a little bit about the market and about what's happening, and then I'll go into a little bit again about supply and try not to overlap with Toby too much, maybe give some slightly different views and interpretations of the data. So first of all, we'll get started and just look at what's happening to the national housing market. UK house prices, as Toby alluded to earlier, actually we're entering a period of stagnation. House price growth has really fallen through. You can't quite see the zero, but it's about there. And so we've had this kind of we had a sort of 2013-14 boom. My suspicion is that the idea of house price stagnation got a bit boring, and actually Osborne was looking for something to kickstart the economy, and the housing market was the perfect way to do it. Bit of a push through funding for lending and other mortgage-related schemes, and got a bit of a boost, bit of a consumer lending boom, and that's got everything going. But since then, the market's really slowed down. The problem, though, is the problem with averages is, and actually we've got quite a good demonstration here, is averages don't tell you about the distribution. You know, between Toby and I, we've got the average amount of hair. It's clearly quite a big difference between how much each of us has. So there's no point looking at just a single national average or aggregate. We really need to look below that to understand what's happening. So this chart here is just showing you what's happened to regional house prices since the crash. And so zero there is the house price back in 2007-8, and you can kind of match the colours with the table. And so London clearly has seen an absolutely astronomical rise in house prices there. This is last month's data rather than today's data, but about 60% above where they were. But you can really see there that they've been very flat for the last 3 or 4 years as affordability issues have come in, and also changes to stamp duty. Whereas we've got other parts of the market, so actually the fastest growing parts of the market now, it's north of England, where house prices are still very low relative to where they were previously, but that's where the greatest amount of house price growth is happening. It's a similar story if you look at activity in the market. So this chart here is showing the red line is total market transactions, the blue line is mortgage approvals. And actually, other than the 2016 stamp duty spike, when everyone rushed to beat the 3% additional stamp duty for second homes, we've pretty much been stuck at about 1.2 million transactions across the UK for the last 5 or 6 years. It's ever so slightly below that, but there was some talk about a Brexit-related slowdown over the summer, but actually there's not a lot there. Nationally, the market is pretty flat, there's not a lot going on. But again, a lot like house prices, actually, once you start to delve down geographically, you begin to see quite a big difference. So this chart is showing you the percentage change in transactions by region since 2014, so when some of those stamp duty changes started to kick in and affordability. And so we've got, for example, London here is down 23%, so transactions 23% below where they were just 5 years ago. The east of England is 16% down, the south east 11% down. Meanwhile, at the other end, we've got the north of England, the northwest is up 15%, the northeast up about 16%, albeit over the last year they've slightly levelled off. So we've seen a real geographical shift, both in terms of house price growth and also in terms of housing market activity. The south of England is stagnating, whereas the north of England has seen a bit of a boom in activity. And I don't do forecasts myself, but a lot of other people do, and there's a lot of kind of consensus that this is likely to continue. We're going to continue to see the London and the south struggle, low levels of transactions, and a bit more activity to come through in the north of England. Now that's all very well, and talking about regions, but actually it also works if you go even lower than that. And so if you get a bit bored with my presentation, or you're playing around on your iPad or laptop, feel free to go to my website, which is builtplace.com, and if you click on the link that says LA Reports, my colleague has actually just about half an hour ago updated on today's ONS data. You can click on a house price report for every local authority in England that will give you a summary of what's happening to house prices and transactions in that area. We do a load of other more detailed stuff as a subscription service, but that's all freely available on the website. Now, it's not just about geography, it's also about the type of person that's active in the market. And so this is showing a breakdown of transactions, market activity by 4 different key buyer groups: mortgaged first-time buyers, mortgaged home movers, mortgaged buy-to-let, and cash only. And the cash only is a combination of a bit of investor and a bit of typically older home movers who are moving without the use of the mortgage. And so you can see that actually historically, prior to the crash, mortgaged home movers were by far the biggest part of the market. But they've fallen and they've actually barely recovered. They're about 63% below where they were in 2006-07, with almost no change over the last 5 years. Mortgage buy-to-let, that was booming, albeit it's a much smaller part of the market. It had actually grown quite strongly, and if you've looked at what mortgage lenders had been planning to do, that was really where a lot of the growth in their mortgage lending was going to come in. But then, again, there's that 2016 spike that we saw in the earlier transaction chart. The stamp duty changes and an increased regulation have really put a cap on that, and so the mortgage buy-to-let market is 63% below where it was in 2006-07, having recovered to very close to where it was previously. Cash buyers have actually done very well, and so they actually recovered to above where they were in 2006-07, but have actually come off slightly, partly because, again, of those stamp duty changes. And so they're about 7% below where they were. The interesting one is first-time buyers. And first-time buyers, if you look at the total numbers, they're only actually 12% below where they were prior to the crash. And if you actually narrow that down and you look at people, the core first-time buyer age group of, say, 25 to 34, they're actually above where they were prior to the crash. So we've actually seen quite a substantial recovery in first-time buyer numbers, but they're a very different type of first-time buyer than they were prior to the crash. Oh, I'll just press one button there. There we go. And a lot of that is related to the mortgage lending market. And so this chart here is showing you the distribution of first-time buyer mortgages by the loan-to-value ratio. So the loan-to-value ratio is how big the mortgage is compared to the price. So add mortgage value over house price. And prior to the crash, the 90% plus market was a significant proportion of the market. We've got about 24% of the market was 90 to 95, and 20% was 95 plus, and actually an element of that would have been 100% plus. So people were borrowing more than the value of their home. Credit crunch hit, and that risky part of the market absolutely died to almost nothing. But since the introduction of Help to Buy mortgage guarantee scheme rather than the equity loan scheme, we've actually seen increased activity by mortgage lenders in that higher loan to value market, although most of it is focused in that 90 to 95% market rather than the 95%. So the 95% market, you can see it's still a very small part, it's only 1%, but the 90 to 95% has grown to 23%, so it's not actually that far off where it was back in this market. So there are higher loan-to-value mortgages available. Part of the problem for prospective first-time buyers is the affordability tests and the fact that you actually need quite a significant deposit. And the affordability tests are based around the idea that in year 5 you will be tested on the mortgage rate that you are on at that time. So if you have a 2-year fixed rate mortgage, in 5 years' time you will be assumed to be on the standard variable rate, which tends to be a bit higher than the fixed rate that you're on, plus 3%. And so so you're actually being stress tested against a rate that could be quite substantially higher than the actual rate you're paying. Irrespective of whether actually in reality, at the end of your 2-year fixed rate, you might then take out a 3-year fixed rate that very low, and so at a much lower level. But what has helped in the last few years is, first of all, you can see that reintroduction of 95% mortgages. There was this gap here where there's basically no data, but we've actually seen a real compression in average mortgage rates right across the loan-to-value distribution. So clearly a 75% mortgage on a 2-year fixed rate is very low. The average is 1.4%, but if you shop around you can probably get it even lower than that. A 2-year fixed rate on 95% is 3%, which is a lot lower than it was even a couple of years ago, but it's still quite a large gap above 75%, so it's much more expensive to borrow a higher loan-to-value mortgage than it was relatively back prior to the crash. The interesting thing, and this is one thing that was in the manifesto, is this idea of longer-term fixed-rate mortgages. With the Centre for Policy Studies released a report suggesting this idea of 25 to 30-year fixed-rate mortgages. Now, I haven't read the report in detail, but I think they could have done with talking to a mortgage advisor, because actually Not all lenders will do this, but there are some, because according to the terms of this stress testing, if you have a mortgage that is fixed for 5 years and say 1 day, the rate that you are stress tested against is your fixed rate mortgage. So the fixed rate mortgage on a 5-year is at 3.4%. So it's slightly more expensive than the 2-year fixed rate, which is 3%, but it's a lot lower than the standard variable rate plus the 3%. So I think we're going to start to see some financial shenanigans going on, and maybe some mortgage lenders who are quite keen to begin to capture a larger share of the first-time buyer market begin to manage their affordability testing processes to take advantage of this. So we've already seen a big shift to 5-year fixed-rate mortgages, but that's likely to continue into the future as we see more competition for first-time buyers. So borrowing the mortgage is actually, it's relatively cheap, and actually if you look at the affordability of people who actually manage to become first-time buyers, it's actually, they're paying less on their mortgage than they probably have in the last 30 or 40 years. The people who are becoming first-time buyers are perhaps the safest, best quality first-time buyers there have ever been. You know, they're stress tested to within an inch of their life, they're highly unlikely to default, you know, they've had their monthly bank account gone through line by line. You know, that's never really happened before. The problem is becoming that first-time buyer, and the big barrier, it's not the cost of owning, it's the cost of buying. It's raising the deposit that is basically limiting first-time buyers out of the market. And this chart here is showing you, the yellow bar is the current average deposit that a first-time buyer needs as a proportion of their income. So for example, in London, you currently need around 160% of your gross annual income to become a first-time buyer. The red line is where it was in 2009, so the depths of the credit crunch. And so that was where typically the highest it was. 2007, a very lax mortgage lending market, is the blue. And so actually you can see everywhere saw a big increase from blue to red. Most have seen it come down and we've bridged the gap, whereas London is the outlier there. There's been barely any change because the market is so expensive, because house prices have risen by so much. And so basically to become a first-time buyer in London, you need to have bank and mum and dad. You know, you're not going to manage it otherwise. And actually, it's not even just bank and mum and dad. There's no point having a bank and mum and dad that's based in the northeast of England where they don't have much wealth or equity in their home. You need a bank and mum and dad that has an awful lot of wealth that they can give to you, so predominantly based in London and the south. So we're seeing a real barrier and a real kind of filtering system there going on of who is able to buy and who isn't, particularly in the London market. And that's likely to continue. As Toby suggested, we're not going to see a significant change in house prices. Mortgage rates are as low as they've ever been. There's talk at the moment about potentially another Bank of England base rate cut. There's an awful lot of competition amongst lenders, so they're really, you know, first-time buyers are a big growth market for them. The cost of debt is going to remain cheap. House prices are going to remain high, and so these barriers to home ownership are going to continue.
So can I ask, does that include the help to buy deposits?
The help to buy the help to buy buyers will be included within it. It won't include them, so they'll look better, but they're going to be such a small fraction that if you were to include or exclude help to buy from this, it wouldn't change the average numbers themselves. Because help to buy, I've got a chart later on that shows it's a big proportion of the new build market, but it's not a very big proportion of first-time buyers in total. And so, actually, on housing tenure, and this is where I'll slightly disagree with Toby, is actually we've seen an improvement in home ownership with a mortgage. And I've actually got two sources here. There's the dotted line, which is the data Toby used, which is the Survey of English Housing, and we're getting the next one out next week. And the blue line is the Labour Force Survey, which provides a slightly larger sample and a slightly more regular update to it. And actually we've seen that flat line, which isn't particularly surprising. So home ownership with a mortgage is about flat, and that's because we've seen an increase in first-time buyers. The big thing that's happening in the market is a massive increase in those who are owning their own home outright. And that's the baby boomer generation increasingly entering and being in retirement, and so having paid off their mortgage, they are now sitting quite happily. There's absolutely no housing crisis for them. There's no housing costs beyond just the upkeep of their home. But people die, they are
Shock
eventually
revelation.
they are going to start dying off in the next 10 years or so, and so we are going to start to see this line come down, and that's going to put further pressure on the overall home ownership rate. And so you actually need to quite substantially increase the number of first-time buyers just to keep a level rate of home ownership overall, given some of the trends that we're going to see in the next 20 years. So we've entered a period where we're doing just enough to stave off the fall in home ownership at the moment, but it's going to become increasingly difficult in about 5 to 10 years' time. Meanwhile, the private rental sector, we've actually seen that flatlining as well, so that it's not actually growing. And there's been an awful lot of talk about landlords selling up, but the weird thing, I can never quite replicate some of the press analysis around landlords selling. And actually, if you look at the number of buy-to-let mortgages, they've actually increased over the last couple of years. There's more buy-to-let mortgages than there were last year and even 2, 3, 4 years ago. So that market is still growing, but actually, because we're seeing just enough people managing to get into home ownership, it's reduced some of the pressure in the private rented sector, albeit we are beginning to now see some of those rental price indices tick up again, so there might be some pressure building over the next couple of years. So that's kind of the overall market. So I'll go in and focus on house building, and this is a similar chart to one that Toby used. And the first thing I'll say is I've got a load of question marks on this, because we do not actually know how many houses we are building in England. We have no idea. We have a pretty good estimate, but we don't know. And actually, this is probably right until about here. It becomes increasingly wrong to the point here where it's about 30, 40,000 off a year. So there's about 30,000 more new build completions than there are suggested by this chart. The problem is we don't even know who are building them. And so it's actually very, very difficult to know what's happening in the new build market with any great degree of accuracy. And there's a couple of problems with that chart in the way that it's interpreted sometimes. The first thing to bear in mind is that actually that's a gross completions level, and actually in some of those housing boom periods what we saw was these big gross numbers of house building completions, but then actually the net effect on the housing stock was much lower because we were demolishing a lot of property, particularly in that post-war period where we were demolishing a lot of slums, city centre slums, and moving people out into the suburbs. But what's quite clear is, and this is done on a percentage basis, so it's not total numbers, so there's a degree of equivalence across it. You can see that irrespective of whatever the numbers say, it does look like there has been a lower level of house building over the last 30 years. And the key thing here is actually, if you overlay population growth, you see population growth begin to fall in the 70s and 80s and early 90s, and effectively we weren't seeing that much of a population growth, but then what we didn't do is then cater for the increased population growth that we've had since the mid-90s. And so I think a bit like Toby, I have some sympathy for the Ian Mulhern argument that there's no housing crisis, there's no supply crisis, and supply hasn't contributed to high house prices, certainly at a national level. I would disagree with him, and I'd argue that there is almost certainly a supply crisis in London and the southeast, and there are probably more localised supply crises of particular types of property in other locations across the UK. And actually, you mentioned Ian Mulhern's report in Inside Housing. I made that list. I wasn't top, I wasn't bottom. So,
well done.
Though I did a report with a couple of my colleagues for the Local Government Association earlier in the year, understanding local housing markets, and we actually identified 18 different housing crises, and it's on the LGA website. And
that will cheer them up.
To the point where there, for some places, it's clearly not about a lack of new build stock, it's about the existing stock. In some areas, the housing crisis is actually more about economic opportunity, stable jobs, rising wages, and things like that. But much like Toby, I agree, housing may not reduce house prices, but it is absolutely one of the core factors that we need in order to solve almost all of these 18 factors. And so, just in terms of the undercount of the house building numbers, the yellow line here equates to the total number of that earlier chart, and the red line is actually the better number that is published by government in their net supply data. Unfortunately, it only comes out once a year in November with a 6-month delay, so it's a bit of a pain, but even that one's not quite accurate. There was some funny stuff going on in Newcastle, but a big issue with that is historically the government statistics relied heavily on the NHBC data, but actually the NHBC data suggests that they've seen flat completions over the last 4 or 5 years, whereas actually the market's growing quite significantly. So we don't really know who is in this gap, but we can kind of infer that actually by looking at other indirect evidence that actually there's been a big increase in the market during that period, by people the likes of in this room. SME house builders have actually done a bit better than some other data suggests. We've seen an awful lot of high density city centre development, which they tend not to use NHBC warranties, and basically anyone who's a bit more cost conscious and looking at using other new build warranty providers. And so we've seen a widening in who is delivering housing over the last few years, which is absolutely fantastic in terms of stability for the market and ongoing increases in delivery. So Help to Buy. Help to Buy is, I've been very critical of it over the years, but the thing it absolutely has done is it's helped to increase the overall amount of delivery in the market. And so these are slightly rough numbers, but they're kind of, the blue plus the yellow is my estimate of what market supply is. So it's basically total new build supply less affordable housing. And then I've split it into the Help to Buy and non-Help to Buy part of the market. Now what's interesting is, historically, if you mapped the total private housing delivery against the number of transactions in the market, you tended to find a 10-to-1 ratio. So that for every 10 transactions, there was one new build private completion. And so this black line is the total transactions divided by 10, so rather than having dual axes. And you can see kind of this trend holding up. And historically, at the start of Help to Buy, that 10-to-1 ratio continued to hold. But actually we can see that Help to Buy has actually helped to widen the market. And so rather than it being 1 in every 10 transactions being new build, it's now more like 1 in every 12, or maybe even slightly more in some markets. And so what don't over-interpret this chart. It's definitely not saying that all of Help to Buy has been additional. It certainly hasn't. We've had that widening in market activity, sort of widening in who's delivering during that period. But it's absolutely helped to increase supply beyond the rate at which you would have otherwise expected it to do so. And it's for this reason that I would be very, very surprised if we saw Help to Buy disappear from the market entirely. It's really quite key to continuing to deliver even the lower 200,000 a year number if you overread manifestos. So I would expect to see Help to Buy continue in some form. Now clearly the first changes that we're going to see is it's going to become focused on first-time buyers, and also there's going to be regional price caps. Now the regional price caps are an interesting application of this problem of taking even just regional numbers and then applying them to local markets. You end up with funny things happening on the fringes of London, where you've got markets that are pretty much part of urban London, but they have the southeast price cap applied to them rather than the London price cap. But actually, where the biggest effect will be is in sort of the areas where we've been seeing increasing housing delivery. So this chart, apologies, it's not the easiest to understand at first, but what it's showing is the proportion of either in the yellow houses or the proportion of flats in red that are currently above the regional price cap. So the new build market. So you have slightly over 30, so it's about 33% of houses in the east of England are above the east of England regional price cap for Help to Buy. Now some of those won't have been Help to Buy transactions, but a large proportion of them were. Whereas over in the northeast, where houses are actually by far the biggest part of the development market, over 50% of new build transactions in that market will be above the regional Help to Buy cap. And so I suspect we will see some fiddly stuff around house price inflation or some other metric used to uplift those regional price caps before they actually come into place, because the effect on the market will be quite significant. And already we're beginning to see developers begin to shift away from those larger property types. And what the builders are buying has been very heavily determined by Help to Buy. And so this chart splits out housing delivery into the different property types. So one of the most significant changes is the two-bed flat. Historically, around 10% of the market. In the 2000s, as we saw the shift to urban development, brownfield development, it then rose and became by far the biggest part of the market, whereas it's fallen down, according to this data, to around 14%. Meanwhile, 3 and 4 bed houses fell relatively, but have increased quite significantly, and that reflects house builders going out and building larger houses. And even the MHCLG research on Help to Buy has suggested that the vast majority of buyers have used Help to Buy not in their decision as to whether to buy or not, but actually whether to buy a property or a slightly bigger property. And most of them have used it to buy a bigger property. And so it's clearly altered what the market has been developing. But as I've said, developers are beginning to shift away from those larger properties slightly, in the nervousness around the future of Help to Buy. And so if Help to Buy were to be more constrained by price caps or by some other factor, then I would imagine we might begin to see those two-bed houses maybe begin to rise, and maybe a shift towards more flats. But what's interesting is actually if you look at a wider measure of the market, so this is the net change in stock. So this includes things like conversions and permitted development rights and basically everything that's happened to the market, is you see a much bigger proportion of 1 and 2 bed flats have been delivered in the market over the last year. And so actually the house builder market has been delivering a product very focused on Help to Buy, but there's been all these other parts of the market that have been building quite a different range of products across a wide range of tenure types and also price points. And again, pointing you back to the website, there's a price report on the website, but there's also a supply report there as well that will give you a brief overview of some of the housing supply numbers for each local authority in England. So feel free to have a look at that. Or we have much more detailed information that if you're interested in, I'll be happy to talk to you about. So just to pick up a last couple of points, Toby mentioned the land market, and the land market is a big pressure, particularly in urban areas. But what's quite interesting, particularly given this week we're seeing a lot of announcements from house builders, is that actually the land accessing reasonably priced land is not a problem for the volume house builders. I wouldn't want to suggest what they're up to, but it's interesting to say the least. And so this chart is showing you the breakdown of everyone's favourite house builder, Persimmon, how much they spend on land, how much they spend on build costs, and then their gross profit. And so the total number adds up to their average selling price. So there will clearly be a change in the type of property that they've developed over this period and where they've been developing it. But what you can broadly see is that the land price has been flat, if not falling, during the period. So the average cost of the land per plot is around 30,000. The build cost, and this is where Persimmon are slightly different, the build cost is absolutely flat during that period. If you look at anyone else, the one other company you can do equivalent analysis for is Taylor Wimpey. They have seen a build cost, and so that tells you a lot about what Persimmon have been doing over the last few years. And so you would really expect over the next couple of years, as they focus on customer satisfaction and quality, to see that extent. But the big point is we've seen an increase in house prices. They've held their costs low, static, and so the increase in house prices has basically led to an ever-growing gross profit. And that's been why the house builders have been one of the best performers on the stock market. It's been very much focused around delivering the profit and the shares back to the shareholders. And so that's quite an interesting one around the idea of land being a constraint. So clearly the volume house builders are doing something there that enable them to benefit from the market, whereas people without strategic land banks, housing associations for example, finding it much more difficult. Those that have tried to buy large strategic land banks at the top of the market are now struggling, and so it will be a real issue going forward. I mean, one of the big things, and Toby said it a lot in the past as well, is this was quite a telling quote from the independent review that Persimmon commissioned, and it really tells you everything about the current house building market. because this wouldn't apply to just Persimmon. Persimmon has traditionally been more a land assembler and house seller rather than a house builder. You know, all of the profit is in the land. It's not in the construction of the houses. You know, for many house builders, actually, it's other people that do that. And so, if you want to change what the volume house builders are doing, you need to change the underlying model of house building. But that's a massive debate for another time. And so that's a very brief run through, but
Excellent.
happy to answer
So
any
thank Neal.
questions.